Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, we are going to take a look at Nike, the absolute behemoth in the footwear and apparel industry. Let's see how much cash flow they make. Let's see what they've done the last decade in terms of financial performance. We'll forecast forward to figure out how much do we think they're going to generate out 10 years from now. And we're going to look at that and say, if today's price, if purchased, how much is it going to earn us over the next decade? And are we going to beat the market by owning Nike? Let's get to work. All right, before we dive into the 10K that's behind me, let's review the 5 key attributes that we used here at this channel to evaluate each security that we look at. Number 1, top line revenue growth. It needs to be there. Got to be growing revenue. Earnings growth, we use enterprise level EBITDA for earnings. We want strong free cash flow. We want little to zero debt or less than 3 times EBITDA debt. And you want a well-priced stock. Stock being well-priced means it's going to outperform the market over time. You want a portfolio of a handful of securities with those key features that hopefully beats the market. And there are a lot of investors that run a focused portfolio of say 20 to 30 stocks that meet some of these criterias, and they tend to outperform or can outperform the market. At least have a better chance of outperforming the market, right? If you hold 20 stocks versus 500 stocks, if you pick the right 20 out of those 500, you have a better chance of beating the market than if you hold the broad average or more securities. You kind of blend into the broad average. So, need to pick only a few stocks. How do you pick it? Well, here at this channel, we use those 5 key attributes, and we use this economic model that I have and I'm gonna run through. Now, if you wanna learn more about this, I highly suggest you check out my website, cashflowinvestingpro.com. You will see a one-pager like this, where I summarize everything I'm gonna go through in this channel. 10 years of historical revenue and earnings, 10 years of cash flow, a forecast, an analysis, and a potential IRR. Check those one-pagers out. It's part of the cash flow club that I produce and run. Okay, let's dive into the 10K. All right, the first thing you want to do is always read the 10K on any investment you make. Physically having to read this 10K every year will limit the number of securities you're going to put your money in. It's going to cause you to focus your money towards the top performing, your best ideas, because reading through this is a lot of work. Now, very first thing, fiscal year is May 31st. So all of these numbers are May 31, 2021 and back 12 months. But let's dig through. There's really interesting information that Nike uses to break out their 10K. So the very first section of the 10K is the risk disclosure. Definitely read that. Right after that is operating results. And Nike does a very good job breaking out operating results by segment. Footwear, apparel, by brand, Nike versus Converse, as well as geography, North America, Asia, Africa, Europe, so forth. And I'm just going to thumb through this really quickly, then we're going to move on. But headline number, right? Strong top line revenue growth, 20% year-over-year growth, $45 billion versus $37 billion. They had a strong uptick for COVID, and we want to try to adjust for that because that's not going to maintain that growth rate the entire time. We need to take that into consideration. Gross margin, decent for a manufacturing company, right? 45% is your gross margin. It's good, not great. Great is like a software company that has almost no gross margin. Almost no COGS, so gross margin's very high. But that's strong. Very little in terms of operating operating expenses. So this $20 billion here drops down to the bottom line pretty easily, $6.6 billion of operating income. The only other thing I want to comment here is they call demand creation, this $3 billion. That's them spending on endorsements. They call it demand creation, but it's them buying athletes to endorse their product. So they kind of break that out, which is nice. And then the $10 billion is their operating overhead. That's their rent, the executives, all the staff, utilities, payroll, all that stuff to run the day-to-days in this line. So in the end of the year, they made $6.6 billion of income. Let's see how much of that stuck in cash. Before we do that, I just want to thumb through the rest of this because it's pretty interesting. So here's your operating results by brand and by type, apparel, equipment. You've got Converse here at corporate. They do a phenomenal job breaking it out. They also talk about in this section, here's your geographic view of where revenues come from. I'm not going to go through the whole 10K because it's a lot, but definitely read it and let's check it out. what I really want to cover is the income statement, balance sheet, and cash flow on the 10K very quickly. Again, you should be reading this. These numbers are all fiscal year May 31st and back 12 months, so May 31, 2021 and prior. We covered income statement already. You also see total number of shares outstanding here. That's both the A and the B share. The B share being vast majority of the shares that have issued, 5.1 billion shares. Now, we don't really use earnings per share in this channel because I feel that number can be manipulated. If you have strong cash flow such as Nike, you can buy down shares to reduce this number to always hit your earnings target. So that's why we stick up to whole dollar amounts. We don't use per share basis. We look at how much total enterprise earnings is the business generating. That's what we really want to value. It's off this 6.6 billion, not the changing of these per dollar basis, which can be affected by the number of shares outstanding. But let's keep going to the balance sheet. Balance sheet you're going to see is super clean with an absolute ton of jack on the balance sheet. So cash and cash equivalents, that's $10 billion right there. And right underneath that, short-term investments. That's basically like my checking account is so full, I need another savings account to be able to put extra cash. That's $3.6 billion sitting in very, very short duration bonds. Incidentally, just a quick fact, the balance sheet on the current asset is organized by liquidity. So you have the least liquid current assets here and the most liquid up top. That's the way they normally organize the current asset list. But you come down, property, plant, equipment, very minimal. It's really, this balance sheet is predominantly cash with $26 billion of current short-term assets. And you look down the liabilities section, current liabilities, $10 billion, and total long-term debt, long-term liabilities, 9. So the current assets can actually cover all of the liabilities of the company. Ben Graham would love that one. Financial strength here, I think, is an A+. Cash flow itself always starts at income, comes down to operating profits. The first third of the business is right here. Then you've got your CapEx, which is purchase of property, plant, and equipment. $695 million, they kind of buried it. But that's them expanding their manufacturing facilities. That's them doing some growth capital investments. It's not the acquisitions that they're making, right? They recently are going into the NFT world, and they've made a number of very successful acquisitions in their history. Those are generally listed in this section, but it's not something that we use in our analysis because acquisitions are somewhat random. You can't forecast them. So we look at the business as a whole. What is it doing kind of organically? And then if the management team decides to make an acquisition, that should be incremental. It should be accretive to the business as a whole. So we kind of think it's going to be upside if we trust that management is prudent with the cash. So then the bottom section, bottom third is your financing section where they, if they issue debt and pay back loans, it's right there. If they repurchase common stock, right there, like they spent $1.6 billion buying common stock last year and just canceling it. That's fantastic. Prior to that, $1.4 billion. Those are big. Oh, excuse me, I'm looking at the dividend line. My bad. I'm looking at the dividend line. This is the dividend, $1.6 billion. Above that, $600 million. That's much better. $600 million in buying back and canceling shares of stock. Prior to that, actually, $3 billion. Prior to that, $4.2 billion. So they've been buying back a lot of their own stock with so much cash that they produce. Let's go put this in our economic model and figure out what we think this business is worth. All right, behind me is the model that we use. You can find this model at cashflowinvestingpro.com. All right, let's check this out. So Nike, 2013, $25 billion revenue. Already no slouch, right? That's a big company. Got a 17% EBITDA margin, making $3.7 billion of jack on the 25. So solid business, and then they continue to grow that number every single year. This is actually pretty neat. Every single year they have grown this revenue number. Well, I just said that, then I'll take it back because COVID. My bad. Okay, almost every single year, but that's still very, very impressive. 7% annualized, CAGR, kind of a compound annual growth rate. If I look at EBITDA is growing at a kind of a slower rate and it has a nice pop here. So this 9% is really kind of being impacted by this 90% year-over-year change. If I look kind of in total by averaging these years and averaging these years and smooth it out, I get about a 7% annualized growth rate, and I like that better. So I'm going to use 7% going forward in a forecast because this COVID bounce that I'm calling it might be a peak, not peak, might be spiked because of pent-up demand, which was here. So we just want to be cautious, smooth that out a little bit. But long and the short of it, I think this checks both boxes for top-line revenue growth and EBITDA growth. Good job, Nike. Let's do enterprise value, right? So how do we value a business, right? So because we don't look at earnings per share, which you would use price per share as a relative comparison, we're going to look at enterprise earnings for the entire company, and we're going to look at enterprise value. That's basically all the stock outstanding times the price plus the debt. That's what we get. So the first thing we're going to do to get enterprise value, we're going to bring up the short-term and long-term debt. So they had $3.1 billion, $1.3 billion of short and long-term debt. That's grown to 9.4. So that's almost 8 times the amount of debt they had just 9 years ago. We'll figure out what they did with that. Excess cash, right? So when I showed you the balance sheet earlier, they've got the checking account, and then they've got marketable securities right underneath that. So this isn't even all their cash. This is just truly the excess stuff that's not needed to run the day-to-day business. And I get a lot of questions on this excess cash. I'll pause here for a minute. It's a hot topic. A lot of people will use all cash as an enterprise value calculation, and that's incorrect. You have to use excess cash. Why? Well, if you're going to buy, let's say, an ice cream shop, just a simple example yourself, you're going to go and you buy it from the guy who's selling the business, and that person takes out every single dollar of the checking account and closes it. Well, then you bought an ice cream shop, but you have no checking account to run it. The business is still going when you're trying to transact between the buyer and seller, so the business is still moving, and you still need cash in the bank account to pay any outstanding checks, to buy inventory. You're going to need something. Otherwise, you as the buyer have to fund that cash that's in the business. So there's it's called working capital, but there's a general amount of cash that any business needs in its checking account to cover the day-to-day, week-to-week ins and outs of the business. One example is payroll is processed every 2 weeks, not every single day. So you're getting sales every day, and then 2 weeks happen, boom, you get a big payroll, and cash balance falls. And then cash balance creeps up as you get revenue in over the subsequent 2 weeks. So cash balance is not flat in a business. It swings. Depending on the type of business, it swings more or less. That's why in a business you need to maintain some cash on the business when you're calculating enterprise value, so it's only the excess that we use. I personally use the short-term investment line on the balance sheet as my excess because if they're buying 6-month treasuries, they don't need that cash to run the business, and so it's an easy line for me to pick up when I'm doing the analysis. So long story long, 2.6 to 3.5 billion. Cash is stacking up with the exception of right here where they're making some heavier investments. But cash is definitely present. Market cap, shares outstanding times price gives me market cap over the time. I'm using the May 30th, first kind of May month because that's their fiscal year. I add debt and market cap. I subtract the cash and I get enterprise value. Enterprise value, again, is the true value of a business. $53 billion, going too fast, to $221 billion. That is a monster move, bigger than 4 times. That's a big move. What has happened, well, let's cover this one first. So the good news here is debt is 0. They have enough excess cash right here to pay off most all debt. I net these two, right? So that's 9 minus 3.5. And then you have earnings every single year that they can pay this with. And this number is basically less than 1 times that number. So when I look at how much debt they can afford, they can put a lot more debt on this business, and our risk of bankruptcy is very, very low. So from a credit position, A+ on a financial statement, us as equity owners, we are always behind debt investors. If you think of a capital structure, capital stack, it's called on a balance sheet, you start with your senior creditors, your Wells Fargo, JP Morgan, the big guys who only led senior A credit lines. Those guys have first claim on all assets, much like a mortgage. And then as you walk down the capital structure, the money, the interest rates goes up, the required return goes up as you get further and further away from underlying assets and a claim on the underlying cash flow. Your required return goes up. Us, as equity owners, as common stock buyers, we are the very, very last, bottom of the barrel people that's standing in the way, in line of the capital stack to get our money back should the business go bankrupt. That's why, all things being equal, you'd much rather have a company that's doing all this work with no debt on it. That means there's nobody in front of you and all the assets. Much better credit protection position than if you bought a company that had all this same information, but this was at 5x. You'd have a lot more people in front of you if the business failed to influence how the company is operated. Don't forget, they can go to bankruptcy court, but the bondholders can also just say, hey, I'm going to take over the business. You equity guys are gone. I'm going to put in a receiver, and that person is going to run the business instead of the management. So it's very important that you keep an eye on debt. Long story, sorry about that. But what I want to get to is right here. The market multiple expansion that we are witnessing is very, very important. So enterprise value EBITDA, that is essentially a payback period. That's enterprise value of the entire value of the business, divided by how much annual earnings does the business make every single year. That's a payback period. You don't get to keep the cash, but it's a way of thinking about, I'm going to buy a business, it's going to generate cash or earnings over for the next 15 years or whatever, and it would have paid itself. That's a great, great idea. You don't have to rely on growth to generate the payback. So historically, it looks like Nike had been sitting at about, 16 times enterprise value EBITDA. And then here it spikes up, and now they're sitting at 29 times. So a very clear change has occurred within the market's response to Nike and its earnings. So the question is, will this continue, or will it revert back to its historical trend? Now, when you look at the markets, 29 times for a business that is growing at an average earnings rate of 9%, albeit this one's very, very high, I get you that. But if you look at revenue is kind of clicking along normally. The margin, EBITDA margin, sitting around 15 to 16%. It's not skyrocketing up. So this blip here is more like a reversion to the mean. You're not going to get another 90% growth in earnings. So investors are now paying top dollar for those earnings, when in reality, growth is going to moderate in the future, and I would expect this number to come down more to a historical average. And when that happens, that's going to weigh on the price of the stock in the stock market, regardless of what earnings do. We'll get there in a bit. All I want to say here is this looks pricey to me. We'll have to see what a forecast looks like and what the IRR of the project looks like to judge if this is too high or not. Here we go. Let's take a look at cash flow. Okay, so we looked at the revenue, earnings, both checked the box. We looked at no debt, great. Let's look at free cash flow. So very first thing, cash flow from operations, that's the first third of the cash flow statement, which I covered on the 10K. Please read it. These are my numbers, but go to the 10K and definitely read the 10K. Did I say read the 10K? Read the 10K. $3 billion has grown to $6.65 billion. Strong growth. And that growth is in line with EBITDA growth. So 10% free cash flow growth over time. Cash flow from operations, which is in line with the 9%? 9% growth of EBITDA. That means that the income statement is fairly accurately reflecting the cash flow statement. Or rather, said another way, the cash flow statement is reflected the income. So they're reporting their earnings, their losses, their gains properly on the income statement. That is a good way to kind of smell check that if you're going off EPS, earnings per share, which is on the income statement, that it's tied to the cash flow statement, which is really the value of any business. That's a good check. Next thing I look at is CapEx, right? CapEx is what they have to put back in the business to grow naturally without acquisitions. It's an obligation. You got to repaint, you got to buy new computers, you have to expand your manufacturing line, you have to update your systems, a new ERP system. There's always something you have to put back in the business. And you want to make sure that is included every single year because that's required. And what I love to look at is the spread between how much cash money do I generate when I run the business for a year, and how much do I have to peel off right away and give back to the business. And here, I made $6.6 billion of cash that landed in the checking account at the end of the year. The very first thing I have to do is peel off $695 million. The neat thing is what I'm left with is $6 billion of hard cash that I, or as the business, need to decide what to do with. Because they have no debt, so it's not like they have to pay much debt. These are $250 million of outflow. It's nothing. That's probably a commercial line or something very, very simple. There's always a little bit of debt. My point here is this is not $5 billion. There's not huge payments they have to make. So this 6 flows through 5.7, fine. 5.7, maybe it's $6 billion of cash. Now, where does that cash go? It goes to you and I, equity owners. Because there's no debt in front of me, any of this cash comes right to the shareholders. Now, Nike, the board, can choose to dividend all this money out. They have enough cash on the balance sheet, they can say, you know what, and what would that be? If they dividend all this money out, it's a $3.60 dividend. The stock is trading at least last year, that's a one-time dividend payment of 2.6%. They could just kick out 2.6% one-time dividend pop, and the business would not feel that at all because they have so much cash. That's essentially what we're trying to do here. We're saying, look, they can take that cash and give it away. They can buy back shares, which is a way of dividending the money at no tax to me, which I love, and they are doing. So they're on average buying back and canceling 1% of their shares. Remember, we saw that on the cash flow from financing section on the cash flow statement. The lower third, purchase of common stock, it's a negative number. That means they're buying back and destroying shares. See, they started at that's 1,781,000,000 shares. Now they have 1,582,000,000 shares. That means if I bought the share here, didn't do a single thing, my ownership of this wonderful company grew over time because they are destroying shares in the market. Fantastic. That's a tax-free way of giving a little boost to me. So that's one thing. They can dividend the money out, or they can let it sit on the balance sheet, which is what they're currently doing. Hence, my excess cash is building up. And hence, if someone were to acquire Nike, me as a shareholder would say, hey, this cash is mine that I earned from prior years. Dividend out that cash immediately before you sell the company. And that's what they would do. That's why excess cash is always held aside. But anyways, getting along in the tooth here. Let's keep moving. Free cash flow per share, price, and a yield. And this yield, 2.6, to me seems pretty low from where they were historically. Certainly back in the day, 6.2, 4.2, those are higher, more market normal yields for a company that's growing at 7% a year in earnings. Not a software growth company like a Salesforce, like a Google, like a Facebook. Like, these are just totally different businesses than a manufacturing product business such as Nike. So I think that's a little rich in my opinion. All right, the next thing we need to do is forecast this business. So we've gone through and looked at 9 years of historical material. The good news is that revenue and earnings and cash flow both seem to be fairly stable and growing consistently, which give us a little bit more confidence in the long-term forecast because historically the growth has been very stable. So what I've done here is I've picked up the 2021 EBITDA, and I'm growing it at 7%, and I continue that 7% out to about a $15 billion EBITDA, which is doubling the business 10 years from now. I'm going to apply an 18 times multiple on these earnings because I don't believe that in the reality, in the long run, this premium is going to be maintained. I think we are in a very pricey market. The Fed is backing out of the market. That is $128 billion of money that is no longer going to be in the stock market. And I think that removal is going to remove demand, and you'll see multiples come down. And that's going to be a big pricing pressure. And so what I want to do is when I'm forecasting, I want to be conservative. I'm buying a business. I'm buying this stream of cash flow. I'm not buying a market multiple expansion. So I'm going to set this back to what I think it's going to be long term. I'm going to grow the business nicely. And I'll give it a little bit of cash, a little bit of debt. And I'll say that they're going to maintain the number of shares outstanding because all that cash can be dividend to me, theoretically. Divide these two, and I get a $169 long-term price target on a market cap of $267 billion of a company out 10 years on this forecast. I can do the same thing with cash flow per share, free cash flow per share. So here, I take the free cash flow per share that I had in last year. I grew it at 7%. And over time, I continue that same growth rate of EBITDA because EBITDA is going to pass through to free cash flow. There's no debt. So EBITDA growth is going to be very similar to cash flow growth. And what I get is I get $7.41, a long-term free cash flow target. I apply an average long-term middle market growth company yield, 4.5% to that, and I get $164 per share. The reason I like to do this is I'll go through and I'll look at the historical figures. I'll come up with a forecast for the business. I'll come up with, I think the stock price is going to be long-term before I ever look at the stock price on Yahoo Finance or in today's market. Why? Because when you look at today's price, it's undoubtedly going to influence how you value a company. So I would suggest that if you are valuing companies, do so without looking at the market price. It would surprise you what you would find. So what we find here is that I've got two different estimates of pricing. 164 on the free cash flow method. I've got 169 on an EBITDA market multiple method. Out 10 years from now, I can average this for 166. I can look in the stock market right now and buy as much shares as I want at $168. That's basically flat in 10 years. That means the stock price is currently pricing in this forecast. Let's see what this does to IRR. So here's our IRR calculation. I've got my string of free cash flow, my proportional earnings of my proportional cash flow of the business. I buy the stock for 168, I sell it 166 in the future. I get this net stream of cash flow on my investment. That is in 4% IRR when I do the math, which is essentially the kind of the yield that you would get over time by owning this stock. It's not worth the risk, in my opinion. This stock, although it is growing and low debt, is dependent on maintaining a very rich market multiple. If that multiple comes down, it will significantly lower your investment return and take a very, very long time to get that back. So we're going to give this a meh because let's recap. Top line revenue growth, yes, it's there. Earnings growth, yeah, EBITDA is growing. Strong free cash flow, yep, check that box. Low debt, yeah, it's zero. And well priced, no, it's not. It's not well priced because I think at the current premium, that has no place to go but down. And I'm not buying a company because of maintaining a strong premium or high or low yield. I want to buy a company that's throwing off a tremendous amount of cash. And in this case, you simply pay too much for the cash flow. If I put this onto a distribution and I said, well, what would I pay for the stock in order for this economic model to make sense? And I think you have to be paying a whole lot less than $122 a share for the stock because of the market multiple pullback. Okay, now this is Nike. If you like what you see here and you want to learn how to do this for yourself because there are more than 3,000 stocks in the US, there's lots more internationally, can't possibly cover all of them, I highly recommend you take my cash flow investing course on cashflowinvestingpro.com. It will teach you how to read 10Ks, how to use this Excel model to fill in the key variables that you need, how to set a conservative forecast that you can put your money against, and then how to monitor that company over time and how to build a focused portfolio of, say, 20 to 30 stocks that you truly believe in and that you read the 10K every single year and you monitor. That is a good way of having a shot at outperforming the stock market. Remember, you want to buy the best companies you can that have the highest probability of being in the market. And in this case, although Nike is a phenomenal company, I think the price you pay for the stock is going to weigh on its long-term return, and I would absolutely wait and keep this on the shelf, and you'll find another time when the stock is down, that's the time to buy it. My name is Cameron Stewart. This is Rational Investing. Really appreciate all the comments and subscribers. Don't forget to hit the subscribe button. Throw a comment down below. Let me know what you'd like to see. There's a lot of people requesting phenomenal value stocks down there. I love the discussions, the chat board. You can also go over to my website, cashflowinvestingpro.com. I've got a cash flow club where I present one-pagers like this on lots more companies that I don't have time to do videos with. And there's a community of activist investors there that we are hungrily reviewing and talking about these companies on the one-pagers. Thank you very much. Really appreciate the time, and have a great day. If I don't talk to you before the New Year's, Happy New Year's. 2022 is coming, and it's going to be a fun ride. I can't believe COVID is still around. It's crazy. We started this channel almost 2 years ago when COVID had just kicked off, and we thought for sure it'd be 6 months, a year, but it's continuing to drag out. Check your portfolio. What would happen if this is the new normal? Make sure you know what you're invested in, because you might have to hold that for a long, long time. Okay, thanks. Bye-bye.